And Steve Brice, Chief Investment Strategist at Standard Chartered Bank, joins in with his perspective. Steve, good to have you on the show. How are you sizing up as far as global volatility is concerned on what the interim trend for markets could be?
Yeah, so from our perspective, we actually believe that this is a reasonable opportunity for those that have missed the boat for equities to actually start putting their toe back into the water. Yes, we've seen a lot of concerns, but whenever you see a pullback, that usually is on some concerns. Obviously, geopolitics leading the way. Data out of Europe also not fantastic, but most of the drivers that we see for a bullish equity environment are still there. We expect volatility probably to fall, and generally global equity markets to do rather well over the next 3 months or so, and obviously over a 12-month period as well. So, pretty still constructive from that perspective.
Steve, so do you think the current round of risk-on mood in global markets is a good opportunity for long-term investors to commit more capital?
We believe so. I mean, so if you take the US market, for instance, a lot of people are talking about the market being expensive, but if you take into account where we are in terms of inflation, actually the market is a little bit cheaper than it has been on average. As long as you don't see inflation in the States, which is currently around just over 2%, moving above 4%, then we should actually expect a re-rating of US stocks, i.e. they're becoming more expensive. Add in earnings growth of close to 10% in the recent earnings announcements, and also the dividend yield, then you're looking at low double-digit returns really for the US market on a forward-looking basis. So from our perspective, that's the sort of outlook we have there. Very similar if you look elsewhere. Europe, profit margins there still low. Yes, the data's weak, and yes, we probably need further action from the ECB. That creates a little bit of short-term uncertainty, but over the longer term, we expect Europe to outperform as well.
Yesterday was an important day from a macro perspective for our market, for India and the economy as well, as you had the CPI number coming closer to 8%, and there was a bit of a disappointment on the industrial production numbers too. Even though it does not highlight the long-term trend where the RBI is fighting inflation, for the interim, do you think it influences trade?
Well, I think you hit the nail on the head. We're all looking at a structural story for India, where we're going to likely see a structural re-rating of growth on policy reform. Now, obviously, we do need to see that come through, and data like this in the short term probably just reinforces the need for that. Monsoon season also going to be pretty important in the short term, but so it may lead to some short-term weakness or volatility in the markets, but I don't think it gets in the way of the longer-term picture that people are looking at. Now, clearly, the quicker we move on policy reform, so far they've been rather piecemeal and quite small, cumulatively probably reasonably significant, but obviously we would like to see more and more reform going through to accelerate the core rate of growth over the next 5 to 10 years. So we're still overweight Indian equities. We like the story. We believe it's a long-term story, not just a short-term. But with valuations where they are, obviously there is always scope for short-term disappointment on the route to strong returns.
Steve, some would argue that India is already a discovered and a crowded trade. The India rhetoric has changed, sentiment has improved, but unfortunately the ground realities haven't changed yet.
Yeah, and I suppose that's true, right? And we're seeing that in the data, but just because you get a new government doesn't mean the economy is going to suddenly accelerate and inflation is suddenly going to fall. All of the points you make are there, and it is clearly, or has been, the darling of investors so far this year. If you're a 3-month investor, would you be concerned about that? You might well be concerned about that. If you're looking 12, 24, 36 months down the line, I'd be a little bit more comfortable with projecting strong returns going forward. But yes, as you say, we do need to see the rubber hitting the road a little bit here to support valuations where they are today.
So then what's the strategy as far as India is concerned? Do you think that there is more upside to the market from these levels?
To be honest, I'd expect some period of consolidation here. So maybe see the Indian market maybe even lose a little bit of ground in the coming few weeks. But I think it's going to be very well supported. I think a lot of people have missed the boat with regards to the Indian stock market. So it went up from fairly on strong foreign buying, domestic buying starting to emerge, but we need to see that really cement itself. And once that happens, then we can get another leg up. But we came a long way in the first 6-7 months of the year. We probably need a period of consolidation before we can build higher again.
So given an option to invest incremental capital, how would you allocate fresh money? Would you have a bias towards developed markets or emerging markets?
So from our perspective, we'd still be looking at the Europe and the US. So Europe probably would actually be higher on our radar, given that we've seen quite a significant sell-off in recent times, and the fundamentals have weakened a little bit, but not from a structural perspective. We expect Europe growth to pick up a little bit over the course of the next 6 to 12 months, and that should allow expanding profit margins. US is probably the place you have the most visibility on corporate earnings, so again that looks a favourable market. But we are becoming increasingly constructive on Asia as well. Economic growth expectations had been in a 2-year downgrade cycle. They're starting to be upgraded. Monetary policy becoming more accommodative, and obviously those countries leveraged to the US and Chinese economies should do well. So within Asia, our top 2 picks are Korea, valuations cheap and leveraged, that US-China story, and India on that structural re-rating that we talked about earlier.